All right, time for some myth busting. So this commenter says, you realize that when Reagan cut taxes, government revenue skyrocketed. After tax cuts were implemented, revenue increased by almost 50% over the next 6 years. Tax increases do not necessarily increase government revenue as the part that got cut off. The last part, let's address it first. Sure, in theory, there is a rate of tax that you can charge where that would reduce economic activity, thus reducing the amount of receipts the government receives. Nobody's really talking about doing that. So, in theory, sure, but in practice, probably not. But let's talk about this first part because the right likes to point to Ronald Reagan as the poster child for why tax cuts are a good thing and how they quote unquote pay for themselves. Now, in 1981, Ronald Reagan did lower the top tax bracket. It was 70% in 1981. He lowered it to 50% in 1982 and then lowered it further to around 28% in 1987. During that same period of time, federal revenue did in fact grow. It went from $517 billion up to $900 billion in 1988. That's a substantial gain, but it ignored, those are nominal dollars, so it ignores inflation and it also ignores growth in the economy. But other things grew at that same period of time other than federal revenue. First of all, deficits exploded. And second of all, Ronald Reagan actually increased taxes 3 or 4 times during that same period of time to try and get the deficit under control. Now, look, I'll admit, I'm just a lawyer, I'm not an accountant, so somebody please explain to me. If Reagan proved that tax cuts pay for themselves, why did Reagan have to raise taxes 4 times during his term? And on top of that, if Reagan proved that tax cuts pay for themselves and the government was generating so much more revenue, why did the deficit expand so much under Reagan if the government had all this money floating around from all these tax cuts generating more revenue? Somebody please explain it to me. I'd greatly appreciate it.